Something massive just happened in the crypto markets. Over $20 billion gone, liquidated in just a short period. And it all started with a single post from Donald Trump. Yeah, you heard that right. One post about tariffs on China, and the crypto markets went into a full-on domino effect. Prices tanked. Leverage traders got wiped out and panic swept across exchanges worldwide. But this isn't just about posts. This event exposed how fragile and hyper-reactive crypto ecosystem can be, especially during times of macroeconomic tension. In this video, I'm going to break it all down for you. What exactly happened, why so much money got wiped out so fast, and what this means for investors moving forward. Stick with me because understanding events like this can help you make smarter moves, avoid big mistakes, and even find opportunities when everyone else is freaking out. So what exactly happened? Let's start with the chains of events. It began with Donald Trump announcing his plans to introduce new tariffs on Chinese goods. Instantly read this as a major escalation in US-China economic tensions. Remember, tariffs don't just affect trade, they ripple through currency markets, bond, yield, stocks, commodities, and yes, crypto. Within minutes of the post, we saw global risk asset wobble. Stocks dipped, bond yields moved, and crypto, being one of the most speculative markets, reacted violently. Bitcoin dropped sharply, leading the entire market lower. When Bitcoin moves fast, everything else follows. Ethereum, Solana, all down double digits within hours. But here's the real story, the massive leverage unwinding. At the time of the post, there were billions in leverage positions built up on exchanges. Traders had gotten comfortable, volatility had been low, and everyone thought the market would keep grinding up. This was the spark that lit the fire. And here's the crazy part. It wasn't just selling that caused the crash. How $20 billion got liquidated? So how did it evaporate so quickly? The answer lies in leverage. In crypto, traders can borrow money to open positions much larger than their actual capital. For example, with 10x leverage, a position controls $100,000 worth of crypto. If the price moved against you by just 10%, your position gets liquidated automatically. Now imagine millions of traders doing that at the same time. As Bitcoin started dropping, leveraged long positions began hitting their liquidation price. Exchanges automatically sold off their positions to cover the loans. That selling pressure pushed prices lower, triggering event into liquidation. It's like a row of dominoes. One falls, then the next, until billions are flushed out. According to data from CoinGlass, over $20 billion were liquidated within 24 hours, making this one of the largest liquidation events of the year. And a huge portion of that came from over-leveraged longs who didn't expect a sudden macro shock. Why does a tariff post affect Bitcoin? Isn't Bitcoin supposed to be separate from the traditional economy? Well, not exactly. Bitcoin and crypto often behave like risk assets, especially in the short term. When investors sense uncertainty, whether it's from tariffs, inflation, interest rate policy, or geopolitical tension, they tend to pull back from speculative markets first. Trump's announced signal potential higher costs for imports, supply chain disruptions, and increased inflationary pressures. That means central banks may stay tighter for longer, which typically isn't good for risk assets. So while crypto isn't directly tied to tariffs, market psychology is. Big funds, traders, and even algorithms react to macro news. And when they all move in the same direction fast, it creates a tidal wave. This is why understanding macro event is critical for crypto investors. It's not just about charts and memes. A single political post can turn the entire market upside down overnight. Leverage and market structure. Let's talk more about the underlying structure that made this liquidation event so extreme. Crypto markets are 24/7. Global and mostly unregulated compared to traditional finance. There's no circuit breaker, no pause. No central authority stepping in when things spiral. On top of that, perpetual futures, the most popular trading product in crypto, don't have an expiry date. Traders can hold positions indefinitely, but if they use leverage, they're always one big move away from liquidation. When markets are calm, this structure creates huge buildup of leverage. Everyone piles in, expecting slow, steady gains. But when a macro shock hits, all that leverage unwinds violently. This is exactly what we saw with the $20 billion wipeout. Before I go deeper, if you're finding this breakdown helpful, hit that subscribe button and turn on notifications. I drop videos every week to help you understand what's really happening in the economy and investment world, without the hype, without the noise. All right, let's keep going. Short-term versus long-term impact. Now let's separate short-term volatility from long-term fundamentals. In the short term, this liquidation event has shaken out a lot of weak hands. Over-leveraged traders are gone, sentiment took a hit, and volatility spiked. Prices might take time to stabilize, but long-term, events like this actually clean the slate. Excess leverage gets flushed, markets reset, and new accumulation phases can begin. Historically, some of the best buying opportunities in crypto have come after liquidation events like this, not before. Think back to previous cycles. Each major crash was followed by a period of consolidation and then a new wave of growth. Smart money looks for these moments to enter quietly while everyone else is panicking. What this means for everyday investors, the key takeaway is this: don't get caught in leverage traps and always understand the bigger picture. If you are a long-term holder, short-term liquidation events shouldn't scare you out of your position, but they should remind you to keep cash reserves, stay patient, and avoid emotional decisions. If you are a trader, risk management is everything. Stop losses, position sizing, and understanding liquidation levels can literally make or break you in moments like these. And finally, keep an eye on macro events. Tariffs, interest rate, inflation, elections, these all have ripple effects on the crypto markets, whether we like it or not. One post, $20 billion liquidated. And a reminder that crypto market is still young, still volatile, and still deeply interconnected with the global economy. The winners in this game aren't the loudest. They're the ones who stay informed, patient, and strategic. If you found this video helpful, tap that like button and share it with someone who needs to understand what really goes on behind those flashy crypto headlines. I'm Thuc, your money guy, making money simple, smart, and stress-free. See you in the next one.